Welcome to Chapter 6, Part 2, where we'll explore the critical concepts of inventory accounting and measurement. Inventory represents goods held for sale in the ordinary course of business, and proper accounting is essential for financial reporting. Let's start by understanding the two main inventory tracking systems. The perpetual system maintains continuous real-time records of inventory quantities and costs. In a perpetual system, every purchase or sale immediately updates the inventory records, providing up-to-date information. The periodic system only updates inventory records at specific intervals, typically at the end of accounting periods. With the periodic system, transactions accumulate throughout the period, and inventory is counted and updated only at period end. The fundamental cost flow equation links beginning inventory, purchases, and ending inventory. Beginning inventory plus purchases equals cost of goods sold plus ending inventory. Rearranging this equation, we calculate cost of goods sold as beginning inventory plus purchases minus ending inventory. This visual shows how the four components relate. Beginning inventory plus purchases equals cost of goods sold plus ending inventory. Now let's examine what costs we can capitalize into inventory. Inventory costs include the purchase price, freight-in charges, and any import duties or taxes. We exclude costs like freight out, selling expenses, and abnormal storage costs that occur after production. These three main components combine to form the total capitalizable inventory cost. Companies must apply the lower of cost and market rule to avoid overstating inventory. The lower of cost and market rule requires recording inventory at the lower value to prevent overstatement of assets. Inventory value equals the minimum of historical cost or current market value. Under the input market view, market value represents the replacement cost to acquire similar inventory. Under the output market view, market value represents net realizable value, which is the expected selling price minus selling costs. When cost is 100, but market value is only 80, we must record inventory at the lower market value of 80. When market value falls below cost, we must record an impairment or write-down. The write-down amount equals the difference between historical cost and current market value. Let's look at the journal entry required to record an inventory write-down. We debit a loss account, which increases cost of goods sold. We credit the inventory account to reduce its carrying value. This visualization shows the debit to loss and credit to inventory that reduces the asset value. Major companies regularly write down inventory when market conditions deteriorate. Columbia Sportswear recorded a $9.2 million write-down due to unsold inventory. Urban Outfitters had to write down $43 million of inventory. Ralph Lauren recorded a massive $160 million inventory write-down. This chart shows the escalating scale of inventory write-downs across these three major retail companies. Let's work through a practical example evaluating inventory for impairment. First, we compare the cost and market value for finished goods inventory. Finished goods have a cost of $50,000, but market value of only $45,000. The finished goods write-down equals $5,000. Next, we evaluate raw materials inventory. Raw materials have a cost of $30,000, but market value of $28,000. The raw materials write-down equals $2,000. Finally, we record a single journal entry for both write-downs. We debit loss from decline for the total $7,000. We credit finished goods inventory for $5,000 and credit raw materials inventory for $2,000. Understanding why the lower of cost and market rule matters is crucial. The LOCM rule prevents companies from overstating asset values on the balance sheet. This ensures representational faithfulness, giving investors accurate information about asset values. Without LOCM, assets would be overstated. With LOCM, we present accurate asset values to stakeholders. International standards under IFRS emphasize net realizable value as the most relevant measure of market value. Inventory errors can have cascading effects across multiple periods. Companies use physical counts to identify discrepancies between records and actual inventory. A single inventory error can impact cost of goods sold, net income, and retained earnings across multiple accounting periods. An error in year 1 flows through to year 2 and typically self-corrects by year 3. Let's recap the key concepts from inventory accounting. Remember that perpetual systems provide continuous tracking, while periodic systems update at intervals. The cost flow equation is fundamental for calculating cost of goods sold. The lower of cost and market rule ensures we don't overstate inventory values. We record write-downs through a loss account when market value falls below cost. Accurate inventory accounting provides investors with faithful representation of company assets and performance.